Good afternoon. I'm going to touch on three topics very briefly. I'm going to start with the single employer pension plans and look at what I think the challenges are there and where plan sponsors can be being blindsided. I want to look at the multi-employer plans, and then I want to talk about the Butch Lewis Act as originally envisioned by the Teamsters and how it would help probably the biggest problem pension plan in the country, Central States. And I want to preface everything by saying that all of the information that I'm going to show you today is publicly available from the Form 5500s, which are electronically available from a wonderful site called eFast2, maintained by the Department of Labour. So if I can get this right, let's just start with single employer funding rules. The Pension Protection Act of 2016 mandated mortality and discount rates for the single employer plans. For those of you that say, well, that's not a problem for multi-employer plans, that might be a problem in a few years' time. What happened in 2008 when the Act became effective? Well, we had the market meltdown. Following that, we had Fed policy for lower interest rates, quantitative easing to still further lower interest rates, and we ended up with a situation where the cost of the single employer pension plans were getting higher. So what happened? We had relief. We've had four, I think, rounds of relief, including one that was regulatory relief rather than congressional relief. And the hope has been that the funding relief is going, despite the fact it's going to wear off, well, interest rates are going to get back to normal. But they haven't. And in fact, we're now 10 years on from 2008, and the interest rate's starting to come down in 2009, and we're still not seeing interest rates return to normal. The other thing that's interesting about the relief is that it didn't impact how PBGC charges the variable premium. The Act basically did two positive things for the PBGC single employer program. It tried to get employers to fund for the termination value of the benefits, that is, the amount of money that the plans would need to cover the benefits on a risk-free basis or a close to risk-free basis. So plans are getting better funded in the single employer world from PBGC's perspective. And secondly, it bumped up the rates, the variable rate and the per head rate for the PBGC premiums, and there are plans out there that are paying roughly $600 per participant per year in PBGC premiums. Yesterday, PBGC released its latest report, and once again, I think this is the second year running, but no doubt somebody will tell me if I'm wrong, the single employer program is now in surplus. And when I first came to the United States, I worked as a contractor for PBGC for many years in a department that's probably been renamed several times, but it was CFND in those days. And at that time, the single employer program was really, really troublesome, so that things have changed dramatically thanks to PPA. This chart is a chart of the AA bond rate since the start of the century. You can see we started, AA is corporate, investable corporate rate. AA bond rate yields 8%. It fell with the dot-com bust as people moved out of equities and got scared on that. And then we had the increase as people got a bit less scared of the equities. And suddenly, 2008, we ended up with a spike in the AA bond rate. Basically, nothing in 2008 provided a positive return except for treasuries, a complete flight to safety. And then following 2008, 2009, we see the impact of the Fed policy to lower interest rates and quantitative easing. And then we get to the very right side of the graph, and we look at 2018, and we say, oh, look, the line's going up. Isn't that nice? And we all start to say, well, this is it. We're returning to the new normal. And then October happened, and we're now at the lowest point. I think we've actually bounced from there but all of a sudden, oops, we're not getting the new normal. Or maybe we are in the new normal, we're not getting the old normal. So what did PPA do for single employer plans? Well, from an actuarial standpoint, it took away all of our smoothing techniques, or most of our smoothing techniques. We have less smoothing, we have market-based discount rates, and as funding relief wears off, plans are going to face higher minimum contributions. So what have plan sponsors done? Well, a lot of them have frozen plans. A lot of them have turned and tried to buy out their inactives, their pensioners and their term vesteds. Please take a lump sum, because we don't want to pay $600 per head in PBGC premiums every year. And it also tries to get ahead of a phenomenon of increasing mortality, increasing longevity, mortality improvements. The longer people live, the more expensive benefits get. In the short term, plan sponsors have been increasing their investment in bonds to minimize funding volatility, and in the long term, they're intending to pass the plan to an insurer and get out of the business at all. So this is not good news from a policy standpoint, unless you're sitting in 1200 K Street, which is PBGC's address. And what I see with some plans that are not following the second bullet and trying to minimize their exposure, I'm concerned that plan sponsors are going to turn around one morning, work out that funding relief is gone, and be blindsided because they're not being adequately informed that we're in a new environment and that costs are going up over time. And that probability or possibility, I think, needs to be shown to the single employers. Very fast, that's my single employer piece. The multi-employer, 2008 again, we had a crisis for many plans. We had PPA put in place really to address the decline in the asset values during the dot-com burst. And so PPA was passed in 2006 with various zones for multi-employer plans to be classified in, and they were required to fix the problems that the Act said they had over 10 years. Benefit accruals, higher contributions. Benefit accrual can now seem pretty low for the contributions. That can be a problem because you can lose the active support of the pension plan if they see too many dollars going to prop up the plan and not enough going to provide future benefit accrual for them. It's over there as well. Several large plans in the red zone were shown not to be able to emerge in a 10-year period, and they ended up using reasonable measures to forestall insolvency. This was a thing put into the plan, into the PPA, so that excise taxes would not be levied on the employers. Even that wasn't found to be enough, and we had plans that looked to be going insolvent. They weren't forestalling insolvent, they weren't avoiding insolvency, they were merely putting it off. So MPRA 2014 was introduced and passed, and it produced a new status called critical and declining status. And that permits reductions in accrued benefits, which was a first since ERISA, and also a partition whereby certain benefits could be passed on to the PBGC so that a plan could have a smaller liability. Several of the troubled plans, including the biggest out there, was not permitted to reduce benefits under MPRA because the Treasury disagreed with the solvency projections after the benefit cuts. And the partition, although it sounded a good thing on paper, it wasn't funded. It basically had to come out of PBGC's own funds, and indeed PBGC had to come up with a way of justifying a partition as it wouldn't impair any future assistance that PBGC would give to future insolvent plans. So the partition was pretty much no use except for very small plans. Looking ahead, most of the multi-employer plans are expecting returns of around about 7.5%. The investment outlook for the next 10 years by most of the investment consultants is for a lower return than that. And what's happened since 2007, and if you recall back to that chart, back to the start of the century when interest rates on bonds were 8%, the bonds have become less and less and less attractive as an investment if you're trying to chase a yield of 7%. So plans are now investing with more risk, meaning that they are increasing their exposure to private equity, they're increasing their exposure to real estate, getting into private debt, mezzanine financing, all sorts of things just to try to produce a return so that they can escape from the PPA zone problem. There are approximately 150 plans facing insolvency over the next 30 years. It may be a little bit more than that, maybe a little bit less than that, depending on your source. Two big ones here, and I hope I'm not stealing the thunder from my following presenter. The mine workers on its 2017 5500 filing said it would be insolvent in the year ending June 30th, 2023. That's not very long. Central States, in its 2018 5500 filing, said it would be insolvent in the year 2025. So, oh, sorry, hang on. Where am I gone? Hello, okay. I thought I had a different slide in there. Okay, so the IBT for a number of years, probably over 3 years now, has been using experts to try to find a solution to the problem, and its biggest problem being Central States, although it's got other IBT plans that are also facing insolvency, to try to use some financial engineering to try to maintain the plan and its ability to pay pensions. So the idea was that the plan could borrow money using Treasury's credit status. So Treasury would sell 30-year bonds to the general public and give those bonds to Central States and charge Central States a small premium to the yield that the Treasury is paying so that the Treasury wouldn't bear any cost and would even make money off the deal. The borrowing plan would then turn around and invest that money to match, using high-quality corporate bonds, the pension payments expected from the current group of pensioners and maybe term vesteds. The contributions in the asset base then is only used to pay the service on the loan that's from Treasury, and that would be interest only for 30 years and then interest and the capital at the end. Now what that does is it turns the cash flow of a pension plan from being highly negative, more money going out in pension payments than's coming in contributions, to something which more equilibrium, because instead of paying out in Central States' case north of $2 billion a year in pension payments, it would be paying maybe $500 million in loan servicing. Now, the first bullet says the plan borrows from Treasury as much as it can afford. So this is a bit of an iterative process for the person doing the sums. We look at what would it cost to buy out all of the retired lives and term vesteds. Can we pay that back with the assets that's on hand plus the future contributions? And if the answer is no, well, that's not going to work because you're not going to have enough money at the end to pay back Treasury. So the last bullet on this page, if the plan cannot afford to borrow enough to cover the whole of the liabilities, then PBGC comes in and takes over. And the Act requires PBGC to be funded for partitioning, but I've never seen where that was coming from. So just to put some numbers in here, and these numbers fluctuate from time to time. At the moment, the 30-year Treasury is round about 2.5%, maybe a little bit lower than that. So Central States borrows $19.5 billion at 2.75% from Treasury. So Treasury is making a turn of 25 basis points on this loan. That covers about 60% of the inactive benefits, so PBGC picks up 40%. Then Central States pays the Treasury $536 million a year for 30 years, and then in the final year pays back that much plus the $19.5 billion borrowed, or about $20 billion. So here on this slide, there are two data series. The first one in black is what Central States is showing on its most recent publicly available 5500. And you can see that this is a chart of assets. The assets run out in 2025 for Central States. It's insolvent. If Central States is allowed to put 40% of its liability to PBGC, borrow $19.5 billion, then its asset base is not used for paying pensions. Its asset base actually grows. This is assuming a 6% return on assets that are not in the dedicated portfolio. The assets grow and grow and grow and grow. 30 years from now, it can pay back the loan from Treasury, and it still has assets that are growing. So that's the idea. It's using some financial engineering at about 2 or 3 places where it can come in. The whole thing, though, relies upon getting the money, getting it invested, making a return, and monitoring what's going on. And I like this chart, but I know a lot of people have problems with it. So I like to think of what we're doing as we're taking a swap. Swap, we're just exchanging one set of payments for another set of payments. The black line starts off in 2018, 2019 as being the amounts that Central States is projected to pay out in benefits. Assuming that we in 2020 get the loan, and we've put in place a dedicated bond portfolio to pay off the inactive benefit stream, then all that the plan is left paying are for emerging actives coming into retirement, which are the green bars. As you see, they're very low and increasing over time as the actives retire, plus the cost of the interest on the amount borrowed, which is the gold bars up until that 30th year, when you suddenly get that big spike as you have to pay back the principal. So what you're doing is you're basically swapping that black line for the top of the yellow bars, and in the early years that gives you an awful lot more breathing room. It changes the dynamics of the plan for you having to sell investments to maintain the pension payments. And a lot of what happened in 2008 was not that there was a calamity because of the fall in the asset values. It was a calamity because there was a fall in the asset values at the time when pension plans, mature pension plans, were having to sell volatile assets in order to make the pension payroll. So this is almost like a rejuvenation plan for a pension plan.